Welcome to Markets in a Minute. My name is Austin Duke. I'm financial advisor and chief investment officer for Diamondback Financial. We are a wealth management firm focusing on clients who recognize the need for solid financial advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, December 22nd, 2025 edition, and the last episode for the year. Let's get started. All right, as a reminder, investment values will fluctuate on a daily basis for a variety of reasons. Our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. Diamondback Financial is a long-only investment firm, which means that we keep your money invested in areas that we feel offer the best opportunities for growth instead of trying to quote unquote time the market. We focus exclusively on traditional investments of stocks, bonds, and cash. So we'll analyze fluctuations in the stock market and interest rates to help drive our overall investment process. So we'll look at the stock market as measured by the S&P 500. This is an index of the 500 largest companies in America. We've given it a little bit of a Diamondback Financial flavor this week. So anything yellow are up intervals. Anything that's maroon or red is are down intervals. But essentially, for the 2 week period, we had a decline in the overall market of 0.52%, which generally speaking is not that big of a move. Not anything that we're super concerned about. The Federal Reserve did cut interest rates by 0.25% as we had anticipated. That was back here on the 10th of December. And similar to what we had in October, the market hit a peak right around that time of that announcement and then saw a little bit of a decline. We did not or have not had a 5% decline like we did back in October, beginning of November. We did recover from that. We did get another interest rate cut. And we think that this Thursday, Friday period ended in a positive territory because some of the economic data that's coming out is suggesting that things aren't as super fantastic as we would like them to be, which may mean we get another rate cut sooner than what we had anticipated even just 2 weeks ago. As far as what's been working, what's not been working, again, for the stock market, these are the companies that have been underperforming, and this is a year-to-date figure. So the market and total return for the market this year has been about 17.5%. So these are some of the names that have performed poorly throughout the course of the year. So United Health, with the largest contribution to a negative position in the market. Salesforce, Procter and Gamble. We could probably argue that a lot of these names that have done poorly this year have been negatively affected by new tariff policies that were implemented by the Trump administration. On the positive side, again, we're seeing the Magnificent Seven names: NVIDIA, Alphabet, which is the parent company of Google, Microsoft, Broadcom, Palantir, Apple, Meta, etc., Tesla. So a lot of the same names that have been driving the market for the past several years, right? Just these top five companies, that's 40% of the entire growth in the market this year from those five names. And again, these are huge returns, double-digit returns, triple digits for Palantir, JP Morgan Chase, right? Like these are very substantial growth numbers, Micron, etc. So that's what's been going on with the stock market. Next, we'll look at interest rates as measured by bonds issued through the U.S. Treasury Department. We feel that interest rates really are the preeminent measure of investment risk. Rates are factored into every investment calculation, including stock valuations. So generally speaking, as interest rates go up, stock prices will come down, and as interest rates come down, stock prices will go up. The green line is where we are as of Friday. Brown line is where we were 2 weeks ago, and this dotted green line is where we were 1 year ago. We have interest rates listed over here on the left-hand side, and then the maturity lengths for the different bonds that are out there listed here on the bottom from 1 month all the way out to 30 years. So Federal Reserve's cut interest rates about 0.75% this year, which is why we've seen these short-term rates have such a dramatic decline throughout the year. But these long-term rates haven't really had much of a change this year. They've pretty much stayed pretty pegged to where they started. 30-year rates actually gone up. 20-year rates kind of stayed almost almost exactly the same. The 10-year rate has come down. The 10-year U.S. Treasury is what is most closely correlated to mortgage rates. And so we have seen a little bit of a decline in mortgage rates this year, but not as much as the short-term rates. So the thing that's positive, we went from essentially a flat yield curve here on the dotted line. Now we're in almost a normal yield curve environment again, where we're feeling like we're back into that mode where we are being compensated for having our money out for a longer period of time as opposed to getting a higher interest rate for shorter maturity bonds. So this should be a good setup for going into the future. As far as doing our investment calculations, it should reflect a more normal investment environment. We did mention the Federal Reserve cutting interest rates. We still have just a 22% probability that they will do another rate cut at their next meeting in January, about a 61, 62% probability at the meeting in March, not and even a 90% by April. So 2 weeks ago, we had anticipated that Jerome Powell will end his term as chairman of the Federal Reserve in May, and that we would not see any interest rate cuts until he leaves and a new chairman comes in. And then we would probably see 3 cuts, maybe even 4 cuts in the second half of the year. So right now, the market's saying something very similar, that we would get a rate cut in June and then another one in September, and then that may be it. So right now, the market's only predicting we get 2 interest rate cuts in the entire year for 2026. Um, but we anticipate that interest rate policy will remain the same unless things deteriorate further. We're not seeing any alarm bells at the moment, but things can always change. So that's where we are for now. All right, as far as our recent developments and investment expectations and implications, there really isn't a whole lot to talk about. We did talk about the Fed already cutting their interest rate. The only other news market moving potentially is Netflix attempting to purchase Warner Brothers Discovery and that whole drama in the making. Um, there really hasn't been much of anything else that we have heard or that we could even find as we're going back through the top stories for the past 2 weeks. Um, it's kind of quiet out there, which is, actually kind of nice, a nice break from what we've been seeing throughout most of the year. Definitely news stories that we've been hearing, but not necessarily market moving news. So it's not quite the end of the year. We still have a week and a half roughly, but they're holiday shortened weeks this week and next week. So don't expect a lot of fireworks or anything that would drive the market largely up or down. We think we'll probably coast between now and the end of the year, and then we'll see what next year holds. Um, Again, economic data is still coming out. There's a lot of skepticism about the numbers that we're receiving, mostly because there are some extrapolations and um, things that they're having to I guess make assumptions about because the government was shut down and they just didn't collect the information. And so a lot of disagreement about the validity of some of the numbers that we've been seeing. So if we believe the numbers that are coming out, then we're seeing inflation moderate and we're seeing um, the unemployment rate increase, which would suggest that the Federal Reserve would have room to issue additional interest rate cuts, um, and try to keep the unemployment rate from going higher. Now, the last reading was at 4.6%. We personally don't um, anticipate that the Federal Reserve will be eager to issue another interest rate cut unless the unemployment rate gets up to like 5%. We could be wrong, but that's just the general impression that we have. Again, we think Jerome Powell is ready to put this on autopilot and be done with his term in May and not make any more waves in the markets. But I think that's pretty much all we had for expectations, implications. We're going to continue to stay invested the way that we have been. We're overweight in international and emerging markets, which we have been this year, and that's paid off. That diversification has paid off. We'll talk a little bit more about how the overall strategy has worked when we, have our next newsletter in 2026 when 2025 is officially in the books. All right, as a final word, I want to talk a little bit about running. So I'm not much of a runner. I don't like it all that much. I have an older brother who played football in high school and also ran track to try and get faster. He is not pictured in this picture. These are Olympic athletes running in the Olympics. But something that I know sprinters will do is called interval training, where they will run fast for 100 meters or a certain distance, and then they will either jog or they'll walk right at a slower pace, but still moving. And then maybe they run 100 meters, and they jog or they walk until they get to the next 100 meters, and then they sprint again. And through that interval training, they'll get faster, and they'll get stronger as well. And so it's not exactly the same science when it comes to investing, but it's okay when the stock market doesn't go up every day and it doesn't run super hard, super fast all the time. So if we have a period where the market does well and then it flattens out or even, decelerates, it goes at a slower pace, that's totally fine. We will often refer to those types of conditions as a consolidation, where, we're trying to maintain a certain average over a period of time, and if we start going too far too fast, then we're, in a position where the market is due for a decline or correction. Like we can't keep running, we can't sprint forever, right? Like we eventually crash, and we don't want that to happen, especially when it comes to the market. So. Um, anyway, just a little visual for you guys. That was something I had been thinking about this last couple of weeks, but it is end of the year. Again, appreciate all those who are sticking with us and trusting us with your investments, and we're looking forward to a really good 2026, both in the market, but as well as improving our relationships with you guys. We've got this new tagline of seeing what's ahead and seeing you along the way. And we want to make sure that we're doing a better job of seeing you along the way and having those conversations that are important to you. So looking forward to that. Merry Christmas, Happy New Year. The office will be closed for the last week of the year. I'll have my cell phone, I'll have a computer. If you guys need something as an emergency, you can still reach out, but otherwise we'll be spending some time with family and um, hopefully getting recharged and ready to start a new year. So thanks again, and we'll see you soon.